Hi friends, what would you do if a sudden financial emergency struck? Would you dive into your savings or liquidate your investments even at a loss? Or perhaps would you consider a personal loan? Welcome to this discussion about an alternative financial solution that could prove beneficial during such times, that is, loans against mutual fund holdings if you have existing mutual funds. Life is unpredictable. So, you can experience a temporary money crunch once in a while for various reasons, say a relative in critical condition, or an unexpected wedding expense, or a medical emergency, etc. In such cash strapped situations, the first idea that occurs is to use your savings and liquidate your investments even at a loss. And if that is still not enough, you look for a personal loan. This, however, is not your best plan of action. Instead of selling your mutual fund investment at a loss, you can get a loan against them. Yes, just as you can pledge other assets like gold and property for a loan, you can pledge your mutual fund holdings for loan. These are secured loans and mutual funds are collateral. Banks like SBI, ICICI, HDFC, and even non-banking institutions like Aditya Birla, etc., offer loan against mutual funds. However, I will just explain few key points to remember and understand this loan. What is the loan eligibility and how much is the maximum limit? You can get a loan only up to a certain percentage of your mutual fund holdings, which depends on your fund scheme and bank. For example, for State Bank of India, it is 50% of the net asset value for the equity fund and up to 80% in case of debt fund. This has a maximum limit of 20 lakhs for equity fund and 5 crore for debt fund. This maximum upper limit also varies from bank to bank. Non-banking finance institutions offer higher limits. Not all banks give loan against all mutual funds. SBI allow only SBI mutual fund schemes. AMCs like ICICI and HDFC has their own list of approved mutual fund schemes and only allows those schemes registered under CAMS. They will ask for CAMS holding statement to check your eligibility. That means they will not allow funds of AMCs like Axis Bank, Mirae Asset, Canara Robeco, etc. That being said, you have to apply this loan at 2 or 3 banks to check how much is your eligibility. Next, what are the interest rates? Loans against mutual fund cost less than personal loans and credit card loans. For ICICI, it is presently 10.75% and for SBI, it is 11.15%. So, mostly we can say it ranges from 10% to 12%. The interest rate is lower if you pledge units of debt fund schemes and it is on the higher side if you pledge units of equity fund. Next, you might be thinking what will happen to the pledged mutual fund. Yes, you continue to earn returns on your pledged mutual fund units, but the bank will have a legal right on your mutual fund to sell it in case you default the payment. You don't have the rights to sell the units until loans are repaid. Next, what is loan tenure? Loan tenure is usually for 1 year and you have to either close the loan account through repayment of loan or renew it after 1 year for the next year if required. The loan processing fees and renewal fees are applicable in this case also, just like any other loan, and it differs from bank to bank. How the loan amount is credited to you? Most banks will give this loan as an overdraft facility in a current account. That means if you have an equity fund of 4 lakhs, you can avail loan of 50%, that is rupees 2 lakhs, and the same is sanctioned as overdraft. And in case you have loan requirement of say only 1 lakh, you can withdraw that 1 lakh from the OD account. Interest will be calculated only on the utilized 1 lakh amount, not on the total 2 lakhs. Suppose if the market falls and the net asset value of the mutual fund goes down, bank will reduce the OD limit. If the person has availed more than the OD limit, bank reserve rights to even sell the mutual fund to recover the fund in case the person has already availed more than the permitted limit and has not paid back the extra utilized amount in stipulated time given by the bank. You can also provide extra mutual fund units as collateral to maintain the earlier OD limit. So be careful in this aspect and watch out regularly if your mutual fund is pledged as collateral. Take loan amount for only what is required. Do not try to maximize the OD limit. Always keep a buffer, and also do not collateralize all your mutual fund investment. That will reduce the risk. The benefit of the OD account is that you do not have to pay monthly EMIs like personal loan or car loan. In case of OD account, you only have to pay the monthly interest portion as minimum loan requirement and repay the principal amount back to the OD account as and when fund is available with you. This offers flexibility in repayment, but remember, it is always better to pay back the portion of principal every month to reduce the loan outstanding and thereby reducing the interest burden also. This OD facility is similar to the loan against gold or FD, but the loan against gold or fixed deposit is having lower rate of interest. Do check that option also before this. We will consider a case study to understand this better. Consider you have a SIP of rupees 10,000 in an equity mutual fund. Assume you are investing this amount for a goal after 20 years, say for your kids' education. After 5th year, you can see you have an amount of rupees 8.24 lakhs in your mutual fund. And at this point, you are in urgent need of rupees 3 lakhs and you have decided to take a loan against mutual fund for this 3 lakhs with a plan to close the loan in 5 years. Let us check this with a personal loan calculator to understand the total interest payable and the monthly EMI. As this is a OD facility, monthly EMI need not be paid, but for simplicity in case study, let's assume you are repaying loan with this monthly EMI. Apart from principal repayment, the total cost incurred in the loan is its interest plus the processing fees. That will come somewhere near 1 lakh. But your SIPs are intact and investment is earning market gains. At the end of the 20th year, you have this corpus of rupees 99 lakhs. Now, let us consider other cases of redemption of this 3 lakhs from the mutual fund account after 5 years. In case of redemption of an equity fund after 5 years, the long-term capital gain tax is applicable. So in this case, rupees 30,000, that is 10% of 3 lakhs is payable as capital gain tax. Let's keep that aside and suppose you have redeemed at 5th year an amount of 3 lakhs and not repaid this amount back to the mutual fund. In such a case, with the SIP of rupees 10,000, your corpus at the end of the 20th year will be only 79 lakhs. Now consider a case you have repaid this 3 lakhs back to the mutual fund as lump sum at the 10th year. In such a case, the corpus at the end of 20th year is 86 lakhs. Another case which most of us can consider is to increase the SIP after the redemption by an equivalent value of this monthly EMI which we earlier discussed for loan, or even more than that to make up for the redeemed amount as your goal is again after 15 years. Here in this case, you can see I have increased the monthly SIP to rupees 16,486 after the redemption in the 5th year, and I continue to pay the increased monthly SIP for the next 5 years till the 10th year, and after 10th year I have reset the monthly SIP back to rupees 10,000 itself. So in such a case, the corpus at the end of 20th year is 94 lakhs. You can once again go through these cases to understand this better. In the first case, you have chosen to take the loan of rupees 3 lakhs against the mutual fund. So your mutual fund is not disturbed and it continued to gain the market gains with the monthly SIP of rupees 10,000. Whereas in the last case, you have chosen to redeem rupees 3 lakhs from the mutual fund after 5 years, and you have increased the monthly SIP to an increased amount to make up for this redeemed amount as your goal is in the long term. The case is again different if you have equity funds of say 1 crore and you want to avail loan for 20 lakhs. Try a few of your cases and see if this option is good for you. It is always better to avoid personal loans and credit card loans for the peace of mind and for reducing that financial burdens. If market is down and if you don't want to sell the investments at a loss, or if you choose to retain the benefit of compounding on the fund, you have this option to avail loan against mutual fund. Loans against mutual fund units as against credit card loans or personal loans seems a better option because of the lower interest rate. Because personal loan is having an interest rate of say 13% to 26%. Nevertheless, the level of interest on loans against mutual fund is typically higher than the loans against gold or fixed deposit. So consider all the options before you decide to take a loan. I'm not advising to take a loan. Better to have a disciplined investment habit and stay away from loans. In the long run, it's about balance and careful financial planning. It's just that loans against mutual fund can provide a lifeline in times of need and they are better than personal loans. As I had shown in previous case studies, try few of your cases and see if this option is good for you. But be informed about this option of taking loan against mutual fund. This may come in handy at worst of times. Informed decisions are most profitable ones. If you find this information useful, subscribe to this channel for knowledge on personal finance for beginners. Thank you, dears.